IAS 12. IAS 12 deals with accounting for income taxes. Companies are required to pay income tax. Income tax paid to the government or payable to the government is calculated using the tax laws. Income tax that is paid to the government is calculated using the tax laws. But the way the income tax is calculated, the base on which income tax is calculated, called taxable income, may be significantly different from accounting income. Is it right? So if you provide the tax liability only on the basis of taxable income, which differs from accounting income, in some year you will provide very high taxation. Let us say in the first year there is disallowance, and then subsequently it will be allowed. Examples like bonus payable to employees is allowed as deduction only it is paid. So it will be disallowed in the first year, but it will be allowed in the subsequent year. So because of this bonus payable treatment, which is different for accounting and tax, you will end up paying huge tax in the first year. Profit will go down, and again subsequent year the profit will rise because you'll have to pay less taxes. Second example is, there are some companies, if they buy fixed asset for scientific and research purpose, then they get 100% depreciation in the very first year, but that is for tax purpose. For accounting purpose, they might just depreciate it in the normal way. Useful life is 10 year, 1/10 they will depreciate. So now in this example, what will happen? Your tax liability will be very low in the earlier year because you have claimed such a huge amount of depreciation. But your tax liability will be high in the future year. The same asset cannot be depreciated again. So here your carrying amount of the fixed asset in the books and carrying amount of that fixed asset for tax purposes is significantly different, as a result of which the year to year tax calculation will vary. If I provide only on the basis of taxable income, our profit will fluctuate. Okay, amount of tax liability will not match with the amount of income that you are showing. So there is a gross mismatch between the income that you are showing and the tax expense that you are providing. So what this standard will do, it will try to eliminate that mismatch by asking you to also provide for what is called deferred tax. So when you provide for deferred tax, it will try to minimize or eliminate that mismatch. Okay. So theoretically speaking, the amount of tax liability that you will be providing will almost be equal to tax rate multiplied by your accounting income. Total of tax expense, which is current tax and deferred tax, will be almost equal to, not exactly equal to, almost equal to your accounting income multiplied by the tax rate. So that brings matching. Okay, like it means what I said, that if you are showing PBT of 200 rupees and if your tax rate is 30%, so approximately you will provide 60 total tax expense, approximately. Whereas if you don't follow this standard, it may happen you may not provide any tax liability in this year, and the next year again your income is 200 and you may provide a tax liability of say 180. So 1 year you will show an income of 200 and the other year the same company shows a profit of 20 rupees, and that is all happening because of your tax figure. But if you apply this standard, then both the year you will approximately provide 60. So both the year your profit figures will be approximately same because you are earning same amount of income. So your profit after tax should also be approximately same. That is the whole idea behind this standard. Now, the standard prescribe accounting treatment for current tax. Two types of tax we will discuss in this problem chapter: current tax and an accounting concept called deferred tax. Current tax is actual amount paid or payable to government. This is what we have to pay to the government based on tax laws. Deferred tax is an accounting concept. Okay. It is not paid or payable to government. It is to ensure matching concept. Okay. So this is deferred tax. So this standard prescribe accounting treatment for current tax and future tax consequences. Future tax consequences arising from, so this what they are talking about is deferred tax. Future tax consequences arising from the future recovery of carrying amount of asset, future settlement of carrying amount of liability, and current period transactions or events that are recognized. So when we will move ahead in this chapter, you will understand the meaning of all these terms. For the time being, understand this small example. Carrying amount of an asset in the books is 1 million. But for the tax purpose, its value is only 0.5 million. In income tax law, you can only deduct in future 0.5 million. So what will happen now? In future, you will be able to get less tax benefit compared to the carrying amount that you are showing in the books. So even though in the books you are going to say write off 1 million, but tax purpose you will only be able to claim 0.5 million. So that means you will be required to pay less tax or more tax? More tax. So that more tax that we will be required to pay when we recover the carrying amount of the asset, that is called in this chapter deferred tax liability. And suppose I change the figure, I make it 1 here, 1.5. So I will recover carrying amount of 1 million, but for tax purpose, I will be allowed a deduction of 1.5 million for the same asset. So I will save tax in future when I will recover the carrying amount of the asset. Is it right? So that saving in tax in future is called deferred tax asset. Same thing for liabilities also, and same thing for certain other transactions and events. Now you don't need to write, just quickly understand. The main objective of the standard is matching concept. To ensure that if you are showing some income, a proportionate amount of that income is shown as tax expense. Then it also indirectly brings concept of accrual and concept of prudence. Concept of accrual means we even provide for tax liability that we are going to pay in future. Since we have earned the income, we have to pay tax. Just because tax laws give you some benefit, what you are doing, you are only postponing your tax liability. Liability is there, but it's only postponed. So accrual. Many authors also believe this standard brings concept of prudence also. How? Now, for example, your PBT is 10 million and your tax expense, current tax and deferred tax. Current tax and deferred tax. Current tax, suppose for some reason, turns out to be zero. You have a lot of deductions to be claimed. If this chapter was not there, then you would have said, oh, my profit after tax is 10 million. Let us distribute the profit. Let us distribute the profit. So you will use that profit and suppose you distribute it as dividend. But next year what happens? Your income is same 10 million, but your current tax may be 8 million now. In order to pay such a huge amount of tax, you need cash flow that you have already distributed. So if you provide for deferred tax in the first year, let us say your deferred tax comes to 30%. So your profit here goes down. Profit goes down just because of this entry. Your profit after tax will be 7. This 3 lakh which you have debited is retained in the firm. Retained means you are not actually paying it. So it's just a book entry. It's like a depreciation, non-cash entry. It reduces the profit but does not reduces the bank balance. So that 3 lakh rupees is retained by the firm and therefore the cash balance is maintained. So that is called concept of prudence. You do not distribute the profit in the first year and then you find there is a liquidity problem in the future year when your tax burden goes up. I will again explain the importance of this standard through this example. Okay. This example will demonstrate why IAS 12 is important for matching. So let us assume there is a company. It has purchased property, plant, equipment of 1 lakh rupees on which it will get 100% deduction in the first year for tax law. But for accounting purpose, it wants to depreciate using SLM method over 5-year period. So if I go to books of account, profit before depreciation and tax 2 lakh, depreciation 1/5, accounting depreciation 20,000, PBT is 1,80,000. I should have provided 54,000 matching concept, 30% of this. And my profit after tax should have been 1,26,000. But it doesn't happen. Suppose you provide only as per tax law. You said, why should I provide 54,000 when I have to pay only 30,000 to the government? Government calculation, 2 lakh income, 1 lakh depreciation allowed by the law. Taxable income 1 lakh and your tax liability comes to 30,000. So the company says that we will provide only 30,000. I have to pay 30,000 only. So they provide 30,000 in the first year instead of 54,000 based on what they have actually paid or payable to the government. So my first year profit after tax is 1,50,000 if we don't follow Ind AS 12. Next year what happened? Same income. Next year depreciation as per tax law will be 0 now. You have already claimed in the first year. So next year my taxable income is 2 lakh and my provision for taxation 30% of 2 lakh, 60,000. You say that I will provide as per tax law. Okay. So how will your profit and loss account of year 2 look like? It will now show a profit after tax of 1,20,000. So then you will say, how does it matter? Now you look at the comparison chart and then you will realize how tax accounting matters in your profit after tax figure. First year is 1,50,000, second year is 1,20,000. Shareholder is worried. Why is worried? If you are a shareholder and you are not expert in accountancy, you would normally look at the last line, bottom line. You are not interested what you have written above. You are interested in bottom line. Okay. You will only understand last year profit was 1,50,000. This year profit is 1,20,000. This P&L account on the screen is simple. The shareholder gets a long P&L account. Okay, one full page. He will not understand where it has gone wrong. Will he understand? No, he will not understand. You are understanding this example because it is simplified. But actual P&L account of one full page which you get, you will not understand what has gone wrong. Can you understand what has gone wrong here? In this example, yes. You will say, oh, last year PBT is 1,80,000. This year also 180. But here the tax provision is 30, here tax provision is 60. That is why the profit after tax is changing so much. So this will cause a panic in the shareholder community. Oh, the company's profit has decreased by 20%. Newspaper headline will say on the front page, this company's profit declines by 20% for the current fiscal. Okay. Share prices will crash. Shareholders will start abusing management. They will even fire bullet on them. You have destroyed my wealth. This is what I have given you my money for. Possible? Yes. Nowadays shareholders are very aggressive. Okay, they want that management should generate return for them. If I am paying you salary, you have to perform. So here comes the role of deferred tax. After applying this standard, you will find that the profit will not fluctuate much. In both year, my profit will be 1,80,000 PBT, and in both year, I will say provide 54,000. So my both year profit after tax will also be almost same. But then how do we do that accounting? We will learn now. So next paragraph number 2, principle of accounting for deferred tax. Recognition of deferred tax is based on the principle that when an asset or liability is recognized. Now what is the logic of this chapter in this paragraph? When an asset or liability is recognized, suppose your balance sheet has asset or liability, assets are recovered, liabilities are settled. Assets are recovered. If it is your debtor, it will be recovered. If it is inventory, it will be sold and you will recover. So that carrying amount of that asset is recovered in future. Carrying amount of the liability is settled in future. But when you will recover the carrying amount of the asset or when you will settle the carrying amount of that liability, it might affect the future tax payment. It might affect the future tax liability. Say for example, bonus payable is appearing in my SOFP, which was disallowed for tax purpose. So when I will pay the bonus liability, I will get tax benefit. So the settlement of this bonus payable will impact my future tax liability. Is it right? I have a land in the book. So when I will sell that land, I'll have to pay capital gain tax. So sale of that land will have a future tax consequence. Okay. So what Ind AS 12 requires, that in order to ensure matching principle, an entity should recognize a DTA or DTL when the related asset or liabilities are also recognized. So when you are recognizing the asset or liability, which you think will have future tax consequence, which you think will have future tax consequence, then simultaneously you also recognize the DTA or DTL. For example, when you don't recognize DTA or DTL, you have a debtor of 1000 rupees and you know that when I will recover 1000 rupees, there is no tax consequence. Do we need to recognize DTA or DTL for that? No. So for every asset or liability, we don't have to recognize DTA or DTL. Only those assets or liabilities which will have future tax consequence, either in the form of more liability or in the form of less liability, then for such item we will recognize DTA or DTL. Like another example, in the books the carrying amount of property plant equipment is 1 lakh. But for tax purpose, only 60,000 will be allowed. But for tax purpose, only 60,000 will be allowed. So this will have a future tax consequence. This will have a future tax consequence. So on that we will recognize the deferred tax. So what is the objective of this standard? Matching concept. It's a matching accounting tool. Now see this small example, example 1 there. ASF Limited has a building worth rupees 2 lakh. The current tax rate is 20%. ASF Limited decides to revalue the building at a fair value of 5 lakh. So in the books of account, the building value will increase by 3 lakh rupees. So it is 5 lakh. By doing so, the entity is recognizing that in future, it is likely to be able to sell the asset for 5 lakh. This is carrying amount. Entity expects to sell it for 5 lakh. But what is the book value? 2 lakh. Earlier, now it is 5 lakh. It is also likely to have to pay tax later on, then it should account for it in the some manner. So I'll just quickly explain how this taxation calculation will be done. This is my books of account. This is for tax purpose. We started from the same point, 2 lakh, 2 lakh. But for accounting purpose, you increased it by 3 lakh. So now it is 5 lakh. But this adjustment will not be allowed for tax purpose. Can you revalue an asset upward by 3 lakh for tax purpose? Will any tax law allow you to do that? No, otherwise people will stop paying tax only. Every year revalue the asset upward. Charge more depreciation. Don't pay tax. Now, how will this give rise to a future tax consequence? Let us say tomorrow we sell this asset for 5 lakh rupees. Next year on 1st April, I sold it for 5 lakh rupees. Carrying amount is 5 lakh in the book. So what is the profit in the book? 0. But income tax department says no. I will only allow you 2 lakh rupees deduction. 3 lakh profit you have to show. Give me tax 30% of 3 lakh. 30% is tax rate, suppose. So you will have to pay to the department 90,000 tomorrow in case if you sell the asset. So what you are doing? You are only deferring your tax liability. You are only deferring your tax liability. By increasing the book value, you have to pay tax because you have increased the book value of your asset. But this tax you don't have to pay now. This tax you will pay tomorrow when you will recover the carrying amount of the asset. So why don't you also provide simultaneously a deferred tax liability also? Is it right? So that is the logic of the standard. You provide DTA or DTL when you recognize asset and liability which have future tax consequence. You provide DTA or DTL when you recognize asset and liability which have future tax consequence. Have you understood this much? Yes. Story continues. Definitions. Point number 3. This chapter is very easy as far as definition part is concerned. because in other chapters definitions are very boring. Now come to accounting profit. Accounting profit simply means PBT, profit before tax. This is the profit as per your statement of profit and loss before making any deduction for tax expense. So what is popularly called PBT. Okay. And then what is taxable profit or tax loss? It is the profit or loss calculated as per tax laws, tax rules, and on which the income tax is paid or recovered. So in short, it means profit computed as per income tax laws. And then what is point 3? Tax expense. Tax expense or tax income is the total of current tax and deferred tax. Total of current tax and deferred tax. Keep in mind, it is not just current tax. For this chapter, it is current tax plus deferred tax. And this is what I have added in this definition. If suppose there is a deferred tax liability because of the difference between account figure and tax figure, then I will add it to current tax. But if it is a deferred tax asset, I will deduct it from current tax. This is just right now for the beginners. Why do we add and why do we deduct? This you can understand if you understand the accounting. What is the accounting of current tax? Current tax expense account debit to provision for current tax, and this will transfer to P&L account. This will go to SOPL as a liability. And what is the entry for DTL? Same, P&L account debit to DTL. So this is also debit to P&L account. This is also debit. So debit plus debit add. But what is the entry you will pass for DTA? DTA account debit to P&L account. So now here it is a credit. Current tax is a debit, for example. So credit and debit, two figures, if it is to be transferred to P&L account, it will be net amount only. Is it right? So that is why if it is DTA, then minus while calculating the total. What do you mean by current tax? Current tax is the amount of tax payable, sometimes recoverable, in respect of taxable profit or tax loss for a period. I don't know in which country government pays you tax for making losses, but they have written in the definition. Otherwise, I'll go and start business there only. Incur loss, untax. Okay. Next paragraph 4 is the easiest paragraph of this chapter. Accounting of current tax asset and current tax liabilities. So what you will do, go to an income tax consultant. Tell him this is my income for the year. These are the transactions I have entered into. So he will calculate your tax liability. Okay, he will suggest you how much advance tax you have to pay. So you will accordingly journalize. So this entire calculation is based on tax law. Tax on income payable for current year is called current tax. Current tax and any tax in respect of previous year to the extent which is unpaid will appear as a liability. If the amount of tax paid in respect of current and prior period exceed the amount due, the excess amount will appear as an asset. Right. See the journal entries below. When you pay advance tax, in some countries, the government is very smart. They say that before you earn only, you start paying the advance tax. The governments probably do not trust you also. So what you will do, you will pass entry every time you pay advance tax as advance tax to bank. And at the end of the reporting period, you create a liability by passing the entry current tax expense account, which is transferred to P&L account, to current tax liability, which will be transferred to SOFP. But in SOFP, what we do, we don't show these two items separately. Although we can show it separately subject to some conditions also, which we'll see later. When is set off or net off allowed? When is set off or net off not allowed? Assuming right now set off is allowed, because this is a liability you have already paid. Why to keep two accounts when both relate to same thing? Is it right? This is what I have to pay to the government. This is what I have paid. So why to keep two accounts? It's only for our understanding and a control. We are keeping accounts separate, but it represents the same thing, payable to the government and paid to the same government. So current tax liability minus advance tax net liability, or if advance tax is more, advance tax minus current tax liability net amount on the asset side if advance tax paid is more. But remember, the standard talks about when will you net off, when will you not net off. Now, suppose your income tax assessment is over. Income tax assessment is over. After your assessment is over, you have to close these two accounts for that particular financial year. Okay. And how do you close it? Current tax liability account debit, bank account debit if your luck is good and you receive the refund. Okay. So some governments give you refund also if you have paid more tax. Most government will ask you to pay the difference. So to bank if the tax liability is more than the advance tax. So this is how the current tax accounting is done. We have just presented in a simple way. Accounting for current tax is simple. It's based on actuals. Based on actual. The liability that you have to provide is given by actual taxable income that you calculate as per the law. Advance tax that you are paying is of course an actual figure, because you are writing a check, you are paying this amount, and when you settle it, all these are actual. Problem arises in computation of deferred tax. Okay, but again, that is not a very serious matter. If you follow the standard carefully, you'll be able to compute the tax base of an asset or liability, and then you can easily calculate the deferred tax. So now what I'm going to do in the next few minutes, first we will understand the procedure of calculating the deferred tax. Okay, that procedure is written in paragraph number, where is that paragraph number? Paragraph number 15. Go to paragraph 15 after a few pages. Very important. That gives you a summary of what I'm going to do in the next few hours after this. First, you find out the carrying amount of asset and liability. How will you find out this number, carrying amount of asset and liability? By applying the respective IFRS standard. Carrying amount will be found out by applying respective IFRS standard. Say for example PPE, apply IAS 16. Provision, apply IAS 37. Intangible asset, apply IAS 38. Then you determine tax base of asset and liability. Now, our entire effort will be in this calculation. Once this goes right, remaining all are just formula. So that is what I'm going to tell you. Wait, determine tax base of asset and liability. That is what is the value of that asset for tax purpose. That is given a name called tax base. Compare 1 and 2. There is a difference. If there is a difference, then only the standard is applicable. If 1 and 2 are equal, there is no difference. If there is no difference, there is the question of DTA or DTL. If there is a difference, the difference is given a name called temporary difference. Temporary difference will be of two types. TTD, taxable temporary difference, and DTD, deductible temporary difference. Don't write, printed in the note somewhere. And then after you have identified this difference is taxable temporary difference or deductible temporary difference, then you compute DTA or DTL by using the tax rate that have been enacted or substantively enacted by the end of the reporting period. So that is the standard. So what you have to learn now, how to compute the tax base of the asset or liability. That we will see